we're looking at. So even before we look at the Python, even before we code, essentially, you need to think about the basis of your trading strategy. Our focus is on FX markets just because I've been in FX markets for many years and I've traded both at Lehman, the more I traded the money at both Lehman and the more of their capital, but also independently for a couple of years as well. So FX is where I kind of feel most comfortable in terms of research and trading, I would say. So I suppose there's two approaches to creating a trading strategy. One is to have a hypothesis-driven approach. So here you come up with an idea that you want to test. So it could be, for example, based upon your own research. It could be lots of other reasons, essentially, how you come up with the idea. I'll talk a bit more about this later on. But essentially, you come up with an idea and you test it. The second is more data-driven. So you try and look at the data and come up with patterns in the data. I'd say the advantages of having a hypothesis-driven approach is potentially it might be more robust because essentially you're trying to take away spurious ideas, which you might find just looking purely at the data. That being said, there have been times when I've done data-driven approaches as well. So I wouldn't totally discount it. And I'd say particularly when you have a lot of data, so maybe looking at stuff at very high frequency, potentially the data-driven can also be quite relevant, I would say. And also, for example, when we do inflation forecasting, a lot of it is data-driven. We collect hundreds and hundreds of different time series, and we basically put it into a regression model. We get an output to forecast inflation. That being said, even if it's data-driven, you have to know what data to put in the model. So you still need to have some domain-specific expertise about the market you're trading. So whether it's hypothesis-driven or data-driven, you still need to understand what you're trading. That's really important. So once we've approached it from that perspective, we then need to think about, do we want to generate the signal directly, or do we want to have it forecast driven? And when I say generating a signal, essentially what we do is we maybe come up with some intermediate indicators, and they don't necessarily have to be the forecast of the asset we're trading. They could be something tangential. It could be like we want to come up with an inflation forecast and so on, and then we use that to trade FX. But the final goal is to get basically a buy-sell signal, a +1 or a -1. Then you have more forecast driven, where you're specifically trying to forecast the asset you're trading. Once you can forecast the asset you're trading, the trading rule ends up being relatively trivial by contrast. But there's two different approaches. One is where we're trying to create direct kind of a signal buy-sell. The other is where we're forecasting the asset price, and then from that we're doing a buy-sell. So let me give you two different examples of how we can do this. And also we have many different data sets essentially that we can potentially look at. There are many different examples of approaches and we can mix them. So we can have a data-driven approach to forecasting inflation, which is what we do at Turnleaf. And then we have a hypothesis that, for example, inflation impacts FX via the monetary policy channel. And then from that, we create a signal to trade FX based on inflation. At no point in this have we actually forecasted FX directly. That's the key point. We've forecasted something independent of FX, inflation, or could be an indicator, and we come up with a buy signal from that. Later, however, we're going to look at it from a different perspective, where we come up with a hypothesis that markets tend to trade, that we create an intermediate technical indicator, and then from that we generate a signal to buy or sell for euro dollar. Even if you have a data-driven approach, it's important, I would say, to have some sort of domain-specific knowledge. Because you need to understand which data sets you need to ingest into the model for one. And where can you gain domain knowledge from your sources? It could be, for example, from courses. QDC is one of them, obviously. Books, the financial press, work experience, LLMs. But ultimately, it's going to be a mixture of different sources that you'll use to come up with your own trading strategies. Before we actually look into a trading strategy, we first need to think about what data we're going to ingest into our model. I won't go into this in too much detail, but obviously the most important data set is the market data. So it's basically the market data of the asset you're going to trade and potentially other markets as well. So for example, we might be trading FX like dollar yen, but we still want to ingest market data from other markets. It could be like US Treasury markets, it could be equity markets as well, and coalesce them to create a signal. But in a nutshell, market data is the byproduct of trading activity. So you'll have trade data, which is actual trades that have been executed between two counterparties, and then you'll have quotation data, which is basically being gathered from quotes. But if there's no trading activity, there's no market data. But I would say that of all the data sets, market data is the most important. If you don't have market data, there's no way to backtest a trading strategy for one. Then we have economic data. So this gives us an idea of how the economy is doing. And this is going to be particularly important if we're trading macro assets. So things like rates, FX, inflation, and so on. And typically we'll look at official sources. Sometimes there might be private sources as well. We'll have growth data, labor data, inflation, consumer data, and so on. So particularly for macro assets, I would say economic data could potentially be an important input into your model for trading. Then if you're looking at trading single stocks, then company data is going to be key for that. So it could be earnings reports, which typically in the US are quarterly. And then within these earning reports, there's going to be lots of different insights. For example, the revenue, the earnings per share, and so on. You can model these as factors independently to kind of trade equities. And then finally, we have alternative data. So this could be data that's derived from outside of financial markets typically. So I co-wrote a book with Alexander Denev, actually, the Book of Alternative Data, all about this. And you might have stuff like satellite imagery, which you could use to understand the supply of, say, crude oil. You could have pollution data, which is a proxy for industrial activity. A lot of text as well, whether it's from news wires like Bloomberg or Reuters or social media. And all of these are not necessarily what you would think of as typical source of financial markets, but they can give you insights into financial markets. Typically, you need to spend a lot of time to structure the data, or data vendors will need to spend time to actually structure the data for you. And this comes down to the point that you have different sorts of data. You have structured data, which is well-ordered data. So price data is an example of structured data because it comes up with every single point is a timestamp with a value, timestamp with a value, timestamp with a value, and so on. While something like a satellite image, it needs to be basically structured. You need to add metadata into it to actually make it usable from the perspective of a trader. So that's important to understand. What are the input data sets that you'll typically use? Obviously, I've gone over it very quickly. There's many different types of market data, many types of economic data. Alternative data is a whole plethora, essentially. It's a massive topic. But in any case, when you come up with a trading strategy, you need to think of what data you need to ingest into the model. That's a really important element of how you come up with a trading strategy. So if we think of sources for market data, there's lots of sources that you can get access to. I'm only going to talk about a few of them because obviously in the interests of time, I can't go over too many sources. But what you typically find is you'll end up trying to source data from many different vendors and areas. And each of them will have their own API, which makes it kind of a bit more difficult to download the data. So what I've done is I've written, this is an open source library. It's called FinDataPy, and you can get it on GitHub. You can have a look at it. And the idea of this is it creates a universal wrapper to download data from many different data sources, whether it's Bloomberg, it's Fred, it's Yahoo, and you have the same sort of template for whichever data vendor you want to download from. If there's a data vendor that's not included in it, you can also create your own wrappers as well. The idea being is you can switch between different data sources relatively easily without having to rewrite all of your code. The first data source I'd like to talk about is Fred and Alfred. So this is from the Federal Reserve of St. Louis. And the nice thing with this data source is it's free. You do need to get an API key, but again, that's free to get access to. But it has very detailed data for the US in particular, and for other countries as well. But it has super detailed data for the US, actually probably better than most vendors, I would say. So you can get, for example, not only do you get the top level data, let's say US unemployment data, but you get all the time series that are basically part of that data set. You also have point in time data as well. So with stuff like GDP, it gets released multiple times, like an advanced estimate. Then it's going to be a final estimate as well, preliminary. But you can basically get all of these collected for each of those different vintages. Um, So I'm going to skip over the GDP one because I don't think we have enough time. I was going to do it, but let's just remove that. But it also has quite a bit of market data as well. So some of it is delayed, but it's fine, I would say, for research. So in this segment, I'm basically creating a market data request using FinDataPy. I put the start date if I want when the data is. I put my nickname for the data, which is euro dollar. I've got the ticker on Fred for euro dollar. I want to have closing data. The source is Alfred, and I need to put the API key, which is basically a long string like a password. I then create a market object, and then I fetch from the market euro dollar. And the key point here is if I want to have a different source like Bloomberg, I would just change the data source and the vendor ticker. I don't need to change any of the rest of the code to do that. And then I can plot it here using ChartPy, which is my open source charting library. And underneath it's using Plotly here. So you can see I've downloaded the data. We can zoom in, we can have a look here. And we've got it up until the end of November, I think, actually. So that's one free source. There's also Yahoo Finance as well, which is a free source as well, which FinDataPy supports. We have Bloomberg. So Bloomberg is obviously a paid source. It's not free, but it does benefit from the fact that you have lots and lots of data, which potentially you can't get from free sources. So particularly if you want to get like FX options data and stuff like that, it generally tends to be paid data. Lots of bond data as well as paid, but Bloomberg is very comprehensive. Obviously, the drawback of Bloomberg is it's quite expensive. So I've got a Bloomberg terminal, so I've logged in here, but that costs like 20, I think 25,000 dollars a year, roughly speaking, something like that. Um, and you can see I've been a client since 2006. So I think probably on Bloomberg, I've spent the same as maybe a Ferrari or two Ferraris on Bloomberg data. But it is good data, I would say, at the same time. So if we want to download from Bloomberg data, you can see it's exactly the same approach, but we're using our data source as being Bloomberg instead of Alfred. We again construct our market data request. We also construct our market object, and then we can fetch the data here. If we want to have intraday data instead of daily data, we just change the frequency flag to intraday in this scenario. And then we can plot the data here on Bloomberg, essentially. I'm not going to use Bloomberg data for the rest of the presentation because I wanted to use a free source, but I wanted just to illustrate that it is easy to download it into Python if you use a source like FinDataPy to do that. So we've shown you basically, we've talked about the various approaches to developing trading strategies, maybe where you can potentially get your ideas from. We've also talked about the importance of data because data is what you ingest into your models, and you've got to be able to understand the data sets available before you come up with a trading strategy. And then I've just shown you very simple methods for downloading market data using FinDataPy as a wrapper, both in the free source of Alfred and Fred, but also using Bloomberg. And of course, there's many other sources that you can get access to. Another very cool source, which I've not shown here, which is also implemented in FinDataPy, is a source called Dukas Copy. And actually, with Dukas Copy, they're a retail broker in Switzerland. They actually publish high frequency tick data. You don't get data for the current period, but you get it up until the previous month. And actually, the data quality is pretty good, I would say, in general. So if you want to back test kind of high frequency strategies, potentially one simple source for doing that is Dukas copy data. It's not going to be as high frequency as you get from inter-dealer sources like EBS and so on, but I would say as a free source, it can be quite nice to play with and at least understand how you can develop intraday trading strategies for FX in particular. So now we know how to download the data. Let's get back to trading strategies. So we're going to we're going to do like a hypothesis-driven approach. But in order to come up with a hypothesis, we need to brainstorm the factors that impact the market. At least in our case, we're going to look at FX. And then from that, we can gather which factor to actually model and come up with a trading strategy. I'm going to summarize some of the important factors for FX, but this is by no means exhaustive. And there's loads of other kind of very specific things which might impact FX markets, particularly at a high frequency basis or an intraday basis. But I wanted to outline, I would say, broader based approaches for factors that could impact FX. And these basically I've come up with from kind of the top of my head, but also I've learned a lot of these by working in FX markets, from reading books, talking to people in the market as well. So it's something that I've gathered over the years in terms of ideas. So what are the main drivers for FX markets? So one is trend. And trend is obviously not unique for FX. It's prevalent in lots of other asset classes. So if you think a lot about a lot of the trend following funds, they end up trading futures in many different asset classes, not purely just in FX. So the idea is markets expect that a price trend will continue. There's a bit of a fear of missing out type of factor, and people jump on that trend. You could also argue that there's kind of like a herding effect, like a behavioral effect. But more long term, you also have trends associated with economic cycles as well. So maybe that's more of a macro reason potentially why you have trends. Um, and the idea is you come up with use a technical indicator, it could be a simple moving average or something like that, and you use that to gauge the trend and trade off the back of it. And that's what we're going to show you later, doing like a simple trend following strategy. Then we have carry. So carry is an important strategy in FX. The idea is you borrow in a low yielding currency like yen, and then typically you'll invest in a high yielding currency like Turkish lira. So you end up being long Turkish lira and funding it in a short yen position. So you end up collecting the differential, the carry between the high interest rate currency that you're investing in and the funding currency here. It sounds like a great idea, but the problem is that you could potentially have all your carry wiped out in an adverse move in the spot market. So let's say you're long Turkey yen, but in the scenario that let's say, so this happened earlier this year. I think at the start of the year, I think the central bank governor was fired in Turkey, basically. So Turkish lira are sold off a couple of percent. So whilst you're collecting the carry, which is like a risk premium, you still potentially can lose your money because of exchange rate moves. Um, so that's something to consider for carry. So when there's a period of risk aversion, the FX can move against you and potentially your carry advantage gets wiped out. But by contrast, it's difficult to be persistently short a high carry currency for a long period of time because you end up bleeding capital, essentially. So that's trend. We have carry, we also have value. So over long periods of time, typically you'd expect currencies to mean revert to some sort of fair value. So one popular metric for this is PPP, purchase power parity. So if you read The Economist, you'll probably have heard of the Big Mac index, where they look at the price of Big Macs across the world and they convert them to dollars to identify which currencies are overvalued and undervalued. So typically on this metric, I think Norwegian krona ends up always being overvalued because I think a Big Mac there is like $10 or something, while somewhere like South Africa ends up looking undervalued because Big Macs are relatively cheap there. The difficulty I'd say with, in practice, obviously PPP will take a basket of goods. It's not going to be one specific good. But the difficulty is it can take a long time for a currency to realign to its fair value. So that's the difficulty I would say is part of that. So a value-based strategy for FX by its nature has to be a long-term strategy. Then we have risk sentiment. So during periods of strong risk sentiment, investors will want to take more risk. They'll buy riskier assets like equities, carry trades, high yielding bonds, and so on. This again is not something purely specific to FX. It could be for other assets as well. Value as well could potentially be something for other assets too, but there'll be a different metric by which they identify what is value, particular equity. So value investing is something quite popular in equities. Obviously, Warren Buffett's kind of one of the big proponents of that. Then positioning and sentiment. Again, this is relevant for many markets. So you want to understand how speculators are positioned. If let's say a lot of speculators are long sterling, the British pound, if there's bad news, potentially you might see a bit of a short squeeze because of that. So people want to back out exit their positioning. And equally, if there ends up being good news, but the market is already heavily long, potentially it won't have a large effect on the market because there's not as many people to come in and push up the price. And also, this also applies to sentiment as well. So one hand is what people have on their books, and also sentiment, where there can be news sentiment or just general market sentiment about an asset. And more broadly, I'd say the fundamentals impact macro, whether it's currencies or bonds or pretty much any asset. So typically within FX, when you have strong economic growth and you have higher inflation, typically bond yields tend to rise because the market is factoring in kind of more tightening monetary policy, and hence the central bank is likely to hike. And typically, I'd say in developed markets, you have a appreciation of the currency. And by contrast, when you have lower inflation prints, typically the developed market currency sells off. Obviously, if you get persistent inflation, I don't think that's necessarily a great reason to buy a currency because over a long period of time, it means the central bank has failed to keep inflation in check. And particularly, I'd say for emerging markets. So in emerging markets, high inflation is generally something that you'd sell the emerging market currency into. And more broadly, I'd say that FX is a market where lots of transactions are secondary. So one example is M&A. So if a US company wants to buy a UK company, they'll need to sell dollars and buy sterling in order to do that. So there could be an M&A positive transaction for sterling. Also applies to when you're buying foreign assets, whether it's bonds, equities, real estate, or whatever. So flows in FX, which are related to other types of transactions, are important to understand from the perspective of understanding where FX is going. More broadly, politics is a big factor now for markets. We've seen this in recent years with stuff like Brexit, obviously with tariffs and the like. So politics is a factor that I think is here to stay as a factor for moving FX markets. And more broadly, I say news in general, whether it's news on politics, economics, what central banks are saying in their communications, natural disasters, and so on. All of these play into the mix of impacting FX markets. So now we've come up here with, again, not an exhaustive list of what drives FX, but at least some sort of list to that we can actually shortlist. So an ideal FX model, I guess, would look at all of these factors, right? So we'd have like a scorecard of different factors, and then from that we'd have our final strategy. But in our case, we're just going to narrow down on one of these factors, trend here, and then we're going to use that to model our trading strategy. We could have obviously taken a lot of these. We could have looked at positioning and sentiment. We could have created a risk indicator. We could have looked at PPP as a value basket. Carry again is a very popular strategy. So all of these potentially we can model. But I'm going to narrow down my focus just on trend because it's probably one of the easiest to look at, in particular from a data perspective, I would say. So let's create our trading strategy. So if we think of what is a trading strategy involves a series of trades where you're trying to optimize your profit in some way. The problem is the only data set we have to test our trading strategy is a historical one, right? But we can only trade in real life going forwards in the life environment. So it does mean that I would say that if you do a back test on a historical data, and if it works, it doesn't always guarantee that it will work profitably. But equally, the flip side is if you're looking at a trading strategy which does really poorly in your back test, something really has to change about the market for it to work in practice. So that's also something to consider at the same time. And then we go back to our idea of a hypothesis. And the rationale behind having a hypothesis is that if we think of all the potential trading strategies there are, there's an infinite number of them. And having a hypothesis enables us to prune that search space to ones that we think are more likely to work. And so potentially we'll prune a lot of spurious strategies which are related to overfitting. Admittedly, the issue is by having a hypothesis, you might actually remove some strategies from your search space which do actually work in practice. So that's the flip side of that. But the idea is that if we have a hypothesis and we can show that the strategy works, both in sample and especially outer sample, live like paper trading, then potentially it might mean it's more robust going forwards. So that's another reason why we have a hypothesis as well. So typically when you develop your trading strategy, what you do is you have an in-sample period, I don't know, maybe 70 or 80% of the sample, and then you keep back a bit of the sample for outer sample testing. And then once you have that, and if it works both in the outer sample period and the in-sample period, then potentially you can think about other ways of trading it in a live basis. So initially people tend to paper trade it. So they'll basically create a trading strategy and they'll trade it with kind of fake money, I would say. So paper trading. So one of the advantages of doing the paper trading is not only is it an additional test for the robustness, but also it can be a potential test for things like transaction costs. So one of the reasons lots of strategies don't work in practice in real life, but they might work in the back test is inaccurate transaction cost assumptions. In a slow moving strategy which trades once a month, okay, it's not going to make much difference. But if something is intraday, I don't know how many times I've come up with a strategy which is intraday, which is like a straight line, the P&L like that. But then when you actually add a bit of transaction cost, it ends up being loss making. Because in a high frequency strategy, typically you're going to target to have a relatively small amount of basis point returns for each trade. So if your transaction costs just balloon out very slightly by, say, half a basis point or a basis point, they can render the strategy unprofitable. And I have heard of examples like in real funds where they've made mistakes on this. They've done the back test and it looks great, and then in real life, actually, the thing doesn't work quite as well. And the nice thing also, I'd say, with paper trading is it can also be an additional check for your back test. So sometimes you might end up back testing and making a mistake. This would hopefully show up when you paper trade it in practice. So it's an additional check and also an additional outer sample check. Um, but let's say once you're happy with paper trading, potentially then maybe you can think about running it live. But I would always caution against running stuff live with a lot of capital. So even if you were to start running it live, I would always suggest a very small amount of capital. And obviously, anytime you run with real capital, you're taking risk. And you have to understand that the risk you're taking, and you could end up losing money. So this is a really important point. Just because the back test works fine and the paper trading works fine doesn't always necessarily mean that the kind of the real live trading will work. So this is a crucial point. You might increase the probability of it working if the back test is working, but ultimately you need to bear this in mind. You're always taking risk and never take more risk than you're capable of losing. So that's a really important point. Um, that ultimately is what destroys traders taking too much risk rather than taking the risk that they can afford to lose. So that's an important point. But that's not a technical matter. That's something you got to think about for yourself. What risk appetite you have if you were to trade, I would say in general. And it's also very different. And I speak from personal experience when you're trading, say, in the bank, and you're using the capital of the bank compared to using your own capital, and you're trying to live off your return. So you have different metrics, basically. So just purely talking about me, when I've been trading my own capital historically, I don't do as much trading these days because I'm too busy with my job. But I spent a couple of years after Nomura basically trading, and then thankfully I was profitable. I had a reasonable Sharp. But you do what would be an acceptable strategy for me to run in that scenario would have to be something with a very high Sharp ratio. Because I was probably leveraged a bit too much, I would say, in perspective. But ultimately, if you have less capital, you have less wiggle room, basically. That's the key issue you have. You can't tolerate drawdowns, basically. So if we think about a back test, what is a back test? It involves trying to simulate how a trading strategy would have performed historically. And you can use several metrics to understand the profitability of a strategy. So one is looking at annualized returns. That's kind of the obvious one. But then you want to understand the risk of a trading strategy. So here, annualized volatility is important. And then the information ratio is just the annualized returns divided by the annualized volatility. And it gives you basically a risk adjusted return. So if you're making 5% returns, but your volatility is 100%, then you're probably taking way too much risk for your return. If by contrast your returns are like 10%, but then your volatility is like 5%, that's actually pretty decent risk reward in that scenario. Um, so I'm going to focus on a trend following strategy. So very simply, a trend following strategy seeks to buy an asset when it goes up, and when the asset goes down, essentially you want to sell it. And this is the opposite of a mean reverting salary strategy when you're buying low and selling high. And they're very prevalent. So particularly, I'd say for intraday stuff, mean reversion might be more prevalent. As you get more long term, then trend following tends to work a bit better. And you have a number of big funds that do trend following, like in the UK, you have Winton, you also have AHL, Man AHL, and so on. And typically they'll trade a big variety of assets. So they'll trade FX markets, bond markets, equity indices, commodities as well. And historically, they've been known as CTAs, commodity trading advisors, because initially these types of funds would have traded commodity futures, but then they expanded to have a look at all the different futures. The difficulty with a trend following strategy is that it's difficult to know whether markets are trending or ranging. Obviously, when markets are trending, you want to be in a trend following strategy. When markets are ranging, by contrast, and they're mean reverting, you don't want to be in a trend strategy. So one example of this is you could try and have a filter to identify when markets are trending or ranging, and I'd say that's pretty difficult. Or you just end up running the trend following strategy all the time, and you kind of have got to accept that there'll be periods of drawdown when you have mean reversion and you have whipsawing in the market. But one way to also to reduce the chances of this is to have trade as many assets as possible, because then potentially at any one time you could have some assets trending. But in order to kind of understand whether your market is trending or not, one important way of doing this is using a technical indicator. So what they do is they take inputs, usually price data, volume data, or something like that, and they transform it into some sort of way that gives you insight for price action. So the simplest one is a simple moving average. So we can illustrate some of these on Bloomberg. So we're going to go on Bloomberg. We'll look at euro dollar. Actually, let me share my screen actually. Um, so there's a few questions here about where do you provide the key for Bloomberg. Unfortunately, Bloomberg is a paid source, so there's I can't provide a key for that. But you can use the free source, Alfred and Fred. That's basically freely available. Um, then I've got a question here, curious about your thoughts on the interaction between spot and futures markets in terms of one dictating the other. So basically, the futures market against the spot market can give you an idea of the carry. So potentially looking at the differential between spot and futures can basically give you an idea of what the carry is. Um, but yeah, I'd say the futures market is kind of a mixture of spot and uh, well, I'd say just, but more broadly, I would say I don't know whether one doesn't really lead the other these days. I think they probably move simultaneously, I would say, because markets are so heavily linked. So if you have a futures contract on CME and a spot one, I don't think you'll have much in the way of arbitrage these days. Maybe historically, maybe, but I don't think you'd have it on these days. Um, so I think it says, will the presentation be shared? I think this is being recorded, from what I can see. So I'll let Quant Insider speak about that. So I'm just trying to answer all the questions now before we get to the end. So in modern HFT, what's the biggest bottleneck today? Is it market data handling, execution latency, or model accuracy? I'll probably let Paul answer that because he's the HFT expert. So I'll let Paul answer that later. But when evaluating a new trading idea, what early signals tell you if it's worth scaling? So I would say the key point is that if I'm looking at a trading strategy, if it's worth scaling, one is, for example, if it's making money. That's one way to look at it. But also, I say if you can find the strategy relatively quickly for a specific hypothesis, that gives me more faith that I'm not data mining it. If I end up spending a lot of time on a trading strategy, it just increases the chance that I'm overfitting something. I'm not talking about getting the data or cleaning the data. That's always time consuming. I'm just saying in terms of the construction of the trading. Also, if it takes me a longer time, I think that I'm more likely to be data mining it, would be my thoughts. Um, so here it says, can we have access to the Jupyter notebook? So I think it is being recorded. I'm not sure whether we'll be able to share the Jupyter notebook, but I would say that the trading strategy I'm going to show you is actually on the GitHub, on this GitHub site. So if I go to in MarketPy, so the code actually for the trading strategy that I will show you is actually on GitHub. Um, So that's probably the easiest thing to share, actually. So I'm going to share that in the links here. So this is basically the trading strategy, the link here that I have here. So that will give you basically a lot of the code for the trading strategy that I will show you anyway. That's probably the most important bit of the presentation, actually, in practice. But let me just show you now Bloomberg. I'm just going through your questions. So let me just share. I probably if I share my whole screen, it's probably easier here. So hopefully you can see can everyone see my Bloomberg screen now?
Yes.
Okay, great. So now you can see with Bloomberg essentially here, I'm plotting various moving averages. So this is euro dollar, and very simply you can see the moving averages. So here I've got a 200-day moving average, and the signal that I'm going to implement is when spot goes below the moving average, I sell. So this would have been a really good trade actually, all the way down here. So we'd have sold here. That we'd have bought here. So we missed the bottom, but we got mostly here. That we'd have bought here and sold there, we'd have made money. Obviously, in this period, you can see that the market was more ranging. So here I'd have lost money by contrast. So this is a whipsaw period. But then again, I would have sold here and bought back here. They made this tiny bit of money. But you can see actually the last leg of the trade here, I'd have made quite a bit of money here. So it's a very simple strategy, essentially, that you can look that we're going to have a look at. And there's lots of other technical indicators as well. There's also Bollinger Bands. I'm a big fan of Bollinger Bands. There's a really good book called Bollinger on Bollinger Bands by John Bollinger, and he talks about using them. So this is looking at trading breakouts. So the idea is when you hit the top of the Bollinger Band, you have an upward breakout, and you can see the volatility is expanding, and so on. And then I've got another question here. I'm a second year student. I want to start an algo trading firm. What should I learn? So the key point is like obviously it's a big thing to start a trading firm, but I'd say the key thing is to learn as much as possible about markets in general before that. So one is to understand how you backtest a strategy. So this is something that I'm going to show you, and you have the code there. So that's the first thing. Then there's also the ability to come up with ideas. So I'm showing you a trend idea, but what about modeling all the different other ideas that I've suggested for FX, and also trying to come up with your own ideas as well. So um, and then I would say I'm not suggesting people go into trading their own money straight away, but at least doing some paper trading as well to try and learn about the market too. Following the financial press as well, so you can learn a lot about different strategies from the financial press as well. So this is a few things that I would suggest, but ultimately it does take time and effort. I would say it's not something that you can learn overnight. So you have to be really keen on financial markets. And I love financial markets. I think it's super interesting. I wake up every day, I look at where euro dollar is trading, I look at where dollar yen is trading. I follow everything. So you need to somehow live financial markets, I would say, because that's an important way you come up with ideas by looking at markets. Um, Okay, so I was curious when looking at time series, is it better to look at raw prices, total change in price, or something in between, like the weighted differences, in order to try to capture both momentum and memory, or possibly all of them? So what I would suggest is that you can look at the raw prices, you can look at the total change in price, you can look at any of these things, but I would suggest looking at multiple parameters. So in my back test, I'm only going to look at 200-day moving averages as an example. But in practice, you would end up with a blend of different models. You could look at, say, 3-month changes, 6-month changes, 12-month changes. So you want to diversify your signal risk as well. Um, I also think it depends what you're trying to do. So, for example, from a pure forecasting perspective, if I want to forecast inflation as an example, I need to make sure that I'm forecast. Typically, you try and forecast quantities which are stationary. So I would try and make sure that I'm looking at something stationary. So in this context, if I'm trying to forecast FX, potentially I would try and make the data stationary maybe by looking at returns and then forecasting the returns as opposed to forecasting the level specifically. Um, then I've got a question here. Um, Okay, there's a question about QDC which I missed. What was the question? Okay. So the question about QDC is how much depth does QDC cover in relation to quantitative development itself? Um, so KDB is covered. It is an introduction, but I would say still quite comprehensive. Um, then there's also a section on Python. So I teach the Python section. There's also a C++ section as well. But what would you recommend for a person already experienced with Python and C++? I mean, with 15 years of experience in real time and low latency. So I can let Paul potentially answer this question, but Paul goes into a lot of depth in terms of developing high frequency trading systems and all the ins and outs of that. And I would say that even if you already know Python and C++, we teach a lot about the market in general as well, aside from that. So it's whilst it's focused on quantitative trading, and kind of the quantitative aspects of how you implement stuff, we also teach you a bit about the market and domain knowledge. So this is still, I would say, beneficial from that perspective. Sorry, there's lots of questions, so sorry I've not answered all of them. I'm just trying to go through all of them. Yeah, so Paul will probably be the best person to answer the HFT stuff. So he's the expert there, I think. Then I've got a question. How long is the time period you use in the back test? I ask because there's structural change over time and it differs across assets. So I would say I typically want to look at a couple of years. So 5 years is kind of the sweet spot. The difficulty is some data sets might not have 5 years of history, like a lot of the alternative data sets. And I would agree with you that you basically will have structural changes. So one example of this, again, inflation, because it's an area I know very well. If I look at a trading strategy on inflation as a signal, if I look at say 2015, 2016, 2017, 2012, basically that 10-year period in the financial after the financial crisis, interest rates were close to zero there, and the central banks were just keeping it there. They were not reacting to inflation prints. So trying to understand where inflation was to trade FX or other markets was probably not useful there because the period was highly unusual. But in the past couple of years, central banks are reacting to inflation. It's gone back to more of a usual market. So I would say you need to understand the various regimes that you're back testing against in order to understand your results in general. And sometimes going back too far makes no sense. Like if I want to do a high frequency trading strategy and I have tick data from 2005, the market microstructure has totally changed. So there's no point basically doing that, I would say, in that type of scenario. Maybe longer term strategies possibly, but I wouldn't say like high frequency ones. It's not really relevant. So here I've got a question here. Um, so I think there's loads of questions. So let me go back to the teaching bit because otherwise I won't finish. But I'll go at the end basically and try and answer all your questions. So what are the steps to doing a back test for trend following? First of all, I say you need to download the market data. We've already done that. And also potentially other sources. But for trend following is the market data. I would say we probably need total return indices. I've oversimplified this in practice. Then we calculate a technical indicator on the market data. Then we create a trading signal based upon the technical indicator. Then we calculate the returns on the market data. We then multiply our signal by the returns of the asset. Then we calculate stuff like the strategy returns, like annualized returns, information ratio, and so on. Then we create an index of our cumulative returns, and then finally we plot our results. Here, I've not done transaction costs, so we should include transaction costs, but the strategy I'm going to look at is really low frequencies, so it won't impact it too much. So I'm just going to use pandas to begin with because hopefully this is kind of the simplest approach. I'm going to download my data for euro dollar going back to 1999. So we have about 25 years of data here. Then I'm going to have a data frame here downloaded from Alfred. And we have here, this is the data for euro dollar that we've downloaded. Then we've got the transaction cost defined. So that's 2 basis points. We're going to calculate the 200-day moving average on our spot price. And then we use MP where, so this is like a big if statement. If the spot price is above the moving average, have a 1 for buy. If it's below, we have a -1. And then we're going to wrap the signal into a data frame then. We calculate the returns on the asset that we're trading. And then finally, to calculate the strategy returns, we take yesterday's signal. That's really important to take yesterday's signal, multiply by the returns from yesterday to today, and then we take off the transaction costs. And then we're going to calculate the annualized returns. So that's the average daily return multiplied by 252. Then the annualized volatility, and then the information ratio is the returns over the vol. And then finally, we can do a cumulative product of our strategy returns and multiply that by 100 to get the final answer here. So this is just looking at 200-day moving average. If we're above the moving average, we buy. If below, we sell. Again, we've simplified it because we've not looked at the total returns of the asset. But you can see actually over a big sample of time, it's not worked too badly, actually. Obviously, you had this drawdown over this period, but broadly speaking, it's still like after funding, it still worked relatively well, I would say. It's not the best strategy in the world, but I would say over the long term, it's worked actually not too badly as a strategy. Um, so what you might find is actually a lot of the things that we're doing are repetitive, like multiplying the signals by returns, plotting, calculating the return statistics, and so on and so forth. So what I've done is I've written a library. Again, this is open source library, FinMarketPy. So it's essentially what I showed you on the GitHub page here. And then this does a lot of the boilerplate coding for doing a back test. So we do a bunch of different imports here. We create our backtest object, our backtest request object. We put all of our parameters for this. Sorry, I'm doing this relatively quickly because I spent a lot of time answering the questions. So apologies, I'm a bit quick on this, but I want to finish before the hour is done in terms of the teaching. So our back test starts at 1999. The finish date is now, transaction costs and so on. We then download the market data again using this market data request type of mechanism from FinDataPy. We fetch from the market this spot prices. Then we create our technical indicator. So this is doing our 200-day moving average on euro dollar spot. We then use the backtest object to calculate our trading P&L. So we give it the parameters of the trading strategy, the asset that we're going to trade, and the signals. So the signals are derived here from the moving average we calculated here with a tech indicator object. And then finally, we just wrap this into we collect the cumulative returns of the portfolio here, and then we plot it. So it ends up looking identical, right, to the previous backtest, but in this scenario, we've basically not had to manually multiply the signals or calculate the returns or calculate the returns. It's all been done internally by FinMarketPy, this open source library that I've written. So the results are pretty good. Again, it's not amazing, but I'd say it's okay as a trading strategy. And obviously, in practice, you wouldn't just trade this. You trade many different assets with trend following. And then what I've done is, if I want to trade a portfolio of assets, I've got a higher level of abstraction called the trading model class. And then what we do is we extend the trading model class in our own example. So we implement it here with a trading model FX trend strategy. We put all the parameters in the load parameters method here, the start date, the finish date, and so on. And also we've got volatility targeting. So the idea is that we adjust the size of what we're trading by the volatility of that asset, and we have it at portfolio level as well. So we don't have equal notional every asset. The notional each asset is proportional to how volatile it is, and also the overall portfolio. So the idea is if markets are very volatile, we'll cut our leverage. If markets are relatively stagnant, then we can actually increase our leverage. Then we implement this method called load assets. So again, we can see these are our assets. We've got euro, dollar, yen up until dollar stocky. We construct our market data request and we download that from Fred. And then the big bit here is construct our signal. Again, we're just going to have a trend following strategy here. So we're just going to do a 200-day moving average. We have our benchmark here which is just going to be euro dollar. And then finally, in order to kick everything off, we instantiate the trading model FX trend. Then we construct the strategy, and that will take a bit of time to construct it. Most of that time is spent downloading the data and practice. The calculations are quite quick. Once it's done, we can do our plot. So this is basically a plot of our trend following strategy across all the different assets. Again, it's done okay. It's not amazing, but I would say still it's roughly a straight line if you look at this, give and take the various drawdowns. And here you can see the leverage of the strategy over time. So during markets which are very volatile, leverage is cut. We also look at the P&L of each of the strategies. And typically, what you tend to observe for each of the different currency pairs is that most of the time you have small losses, but occasionally you have very big gains. And that's a characteristic of trend following strategies that you have lots of small losses, but a couple of big gains. So it's a bit different to being long equities, where typically you make lots of small gains and you have big drawdowns in practice. And then this is looking at the returns of the trading strategy by asset. So you can see dollar yen has kind of lost quite a bit of money recently. It's probably the main thing that's dragged down the strategy. And then finally here we basically we can create a summary of all of our statistics here. So that's just running you through very quickly. And if you want to have the code for this, for doing a lot of this, it's this code here, basically. That's the key bit of code in this example here. Yeah. And so that will give you all of the code basically for the final trading strategy. So you can play around with, for example, removing the signal volatility targeting, which assets you want to trade, and so on and so forth, essentially. So that's probably the main bit to actually have a look at, I would say, in practice. Um, so let me go over the questions. Can I answer the questions, or have we finished the time?
Yeah, we can continue, Said. We can continue.
Oh, okay, cool. So here I've got a question. If you already have a good back test for a trading strategy with in-sample and out-sample data, and then you go live, how could you possibly determine if it's been overfitted, or it's not going to work anymore? Is there a way to have a quantitative method to these situations? So I'd say in general, you have more faith if it's working in a paper trading environment, but there's not necessarily a way to say that it's going to work going forward. So one example of this is a month-end strategy in FX. So historically, what tended to happen is portfolio managers trading equities and bonds at the end of the month, they would re-hedge their FX. So basically, roughly speaking, if S&P 500 goes up over the month, they'd have more dollar assets, so they'd sell dollars at the end of the month at the fix. If S&P goes down, they'd have less dollar assets and have to buy dollars to readjust their hedge. And this strategy, I remember at Lehman we developed, it was around 2005. It worked really well for like 15 years or something like that. But in the end, these portfolio managers basically changed their behavior because they realized that other people in the market were trying to trade at the same time as them to take advantage of the way they were re-hedging. So their behavior changed, and now the strategy doesn't work as well because they hedge throughout the month. So that's not something you could have predicted. It's just that the behavior of people changed that you were trying to tag onto has stopped. So I don't think there's a hard and fast way of doing it. But one thing that you can do is you can look at the historical distribution of your returns. And this is particularly relevant, I would say, for higher frequency strategies. And if the distribution changes very quickly and you don't really understand why, then potentially the strategy has broken or potentially the behavior has changed of market participants. So that's the one thing that I would look at. And also, you can tell if it's overfitted if it only works with one specific set of parameters. So here I've chosen 200-day moving average. But this strategy works with 60, 100, 150, etc. So it actually works over many different parameters. So another thing you can do is look at the sensitivity of your strategy to various parameters. And sometimes that might be a very specific good reason why it only works with a parameter. So with the month-end strategy that I told you, there's a reason why it works at the end of the month, right? Because of this behavior, or historically. So it shouldn't work every single day of the month, by example. So yeah, it is difficult to tell, but that's one way you can look at sensitivity analysis and things like that, and also monitoring the distribution returns. But I would say it's not easy. And there's not a hard and fast answer for this. And but you do get a feeling over time, I would say, kind of like a sixth sense on that. How do you define target variables and combine models? How much data can be used for training, validation, testing? What is your stop loss strategy? So typically, for your stop loss strategy, ultimately you end up running it across your whole book. You can also run stop loss strategies on individual trades as well, but ultimately you have to have one on your book. So if you work at a bank, you'll have one on your book because at some points they'll say, look, you can only have 3% drawdowns or something like that. I'd say data in terms of training, validation, and testing. I think probably training and validation, maybe 70, 80% of the data. and then you leave 20% for outer sample. But ultimately, the only real test is potentially paper trading and with real money ultimately. So even if you end up splitting up your sample like that, you still need to have some period of paper trading anyway on top of that. Like I would not be confident about running a strategy without paper trading it first, really. That's not the best approach. Um, yeah, so somebody said that I would like to connect. Yeah, feel free to connect with me on LinkedIn. That's fine. So somebody said, yeah, Mehul said, yeah, generally it's recommended for two-thirds for training, one-sixth for validation, and one-sixth for testing. Yeah, I think that's fine. Um, so then there's a question here on HFT about, yeah, you do need to be a very good programmer, I would say. I think Paul would concur. It's super important actually to be a good programmer, I would
Agree,
say.
yes.
Yeah. So why did I pick FX for trading? It's just because I started work at Lehman in FX and I got placed on the FX desk. So I ended up spending my career in FX. And I just think it's really interesting. Is it an easy asset class to be profitable in? I would say probably not. But I would say that for any trading, no specific trading is easy. But I like FX because I like to follow macro events and things like that. I like to follow what the Fed is doing and so on. So it fits with me more than following individual companies, I would say. Um, so when working with time series cross validation, how many folds do you use? What is the fold structure? Um, when working with price prediction, it seems that XGBoost, CatBoost, and Random Forest usually outperform deep neural networks in terms of prediction power. So I'll tell you from the point of view of inflation, because that's my area which I spent the past few years on. I'd say in general, we tend to use stuff like Random Forest and Lasso. We have tried to use neural nets and it's not been as successful. But I'd say that the issue there is that our data set has lots of X variables, but it has relatively small number of time points. It's like monthly time points. So potentially there's not enough data, I think, for a neural network to fit. So, but I'll let Paul concur on that about high frequency trading. So it's not my area. So how do you determine the strategy capacity or the market impact? So potentially, I guess this is a bit of it really depends. I would say it depends upon how much your P&Ls per trade. So if your P&L per trade is, say, that's 300 basis points, the transaction costs are not going to make that much difference. But then if your transaction costs are like 1 basis point, then potentially you can just look at, for example, if you're a market taker, you could look at the bid-ask spread. Obviously, not every strategy you're a market taker. Some you'll be giving liquidity to the market, but I would say it depends upon how frequently the strategy is. Then how do you define capital allocation for each strategy? So the simplest way is equal notional, but the problem is each asset has different volatility. So the simplest way I would say is just vol scaling. Obviously, there's more complicated ways of doing this. You can use mean variance optimization, but then you have an issue with understanding the correlation and so on. But I'd say allocation of capital to strategies is probably even more important than the signal in practice. Do you manually decide when there's a regime switch? I guess so in practice. You can have like Markov switching models as well. But ultimately, it's going to be a person which works out whether you turn on and off a model, I think, in practice. Okay. So somebody was just said about Andrea about Markov models be used for regime switching. So that is potentially something that you could use in practice. Um, then there's in comparison for equity market making systematic strategies, what other factors are there to look out for? So that's not my area of expertise, so I don't think I can answer that. So how did the introduction of volatility adjustment impact the performance of your strategy? It makes it a lot better. And actually, that's a good exercise for you to do. If you run the same strategy without vol scaling, you'll see that the information ratio is basically half. So that's probably the big secret of trend following, that if you have equal notionals, you'll end up basically having a lot smaller information ratio. Because ultimately, then your strategy will just be overly weighted towards the volatile assets. So particularly if you trade multiple asset classes. I've seen regime switching volatility models, at least in equity portfolio strategies. We calculate if the regime has switched or not, and then we keep it as an independent variable in the regression model. That's absolutely fine. I think if you have a regime switching model, you can do that. One issue I would say with regime switching models, if you, and you see this with carry actually, carry that lots of people have regime switching models. The issue is if you get it wrong repeatedly, you can end up making your returns worse in practice. In terms of brokerage, so is a combination of forex.com and MetaTrader 5 a good setup? So I can't comment because I've not used any of them. But what I would say is the ones that I'm aware of are kind of the more professional ones, and I'm not affiliated with any of these. People like Interactive Brokers, there's also Saxo Bank, there's Dukas Copy, etc. And you could just you can compare the bid-ask spreads as a simple basis as well. Um, so an outlier defined by statistics might be a signal in the market. Fat tail risk needs to be taken care of. How do you decide whether an outlier is a noise or a signal? So this is a really difficult question. And then one example of this is, so one thing we do at Turnleaf, we also predict non-farm payrolls. And with payrolls during 2020, you had a massive outlier because I think in one month, basically payrolls were down about 8 or 9 million. So that was actually a genuine outlier in practice. So it wasn't a fat finger or anything like that. But then if you're fitting a regression model trying to forecast it, should you include that point? I'd say probably you'd probably use your discretion and say, I'm not going to include those points because that was something like a freak event. And whilst it was real, it doesn't necessarily mean that I want to include it. The same, for example, with Euro Swiss, the Swiss National Bank took away the floor for trading Euro Swiss. I think Euro Swiss moved 35% in a minute. That was a genuine outlier, but it doesn't necessarily mean that you ended up with is something that you want to include in your regression. So here we've got one last question. So, and this I'll call it a day here, and I'll let Paul essentially answer the questions after this. How do you pre-process data before modeling? So I'll talk purely about inflation data because that's where I've spent a lot of time the past few years. So an important thing that we do when we pre-process the data is to make it stationary. There's also specific factors that are important, depending upon your problem. It could be like deseasonalizing the data, maybe also imputing data for missing points as well. That's important because if you have a big regression and then some of your data is only a short bit of data, you'll have to impute the missing data. So there are a lot of stages beforehand that you need to do before you actually ingest it into your regression model if you're doing forecasting. Um,
Said, I had one question. Uh, yeah. Hello.
sure, sure.
Yeah. So basically we have been working on like we were recently trading cryptocurrencies using, but I have wanted to apply similar idea for FX as well, but it's not very similar, but just an idea that how can we use Ganger casualty or like time varying casualty like using proxy FX and using those proxy currencies to predict another currency, something like that.
Yeah, so what you tend to find is that you'll find that if you do like a minimal spanning tree or something like that of the various FX pairs,
Yeah,
you'll see that some drive others. So
yeah,
one example of this is like Aussie and Kiwi,
yeah,
Australian dollar and Kiwi dollar, or Norwegian krona and Swedish krona. So you might possibly see lead lag effects, but I think I've found that it can be quite difficult to trade, I'd say, in practice. Also with emerging markets as well. So what tends to happen is when risk sentiment is really positive in emerging markets, uh, initially people buy the currencies that have good fundamentals, but then when risk sentiment is so strong, they just buy everything. So all of the EM currencies, right? You can see this in stocks as well.
yeah,
So when risk appetite is strong, even the companies that have really bad fundamentals, people buy essentially. So you can see a bit of a lead lag effect, but in terms of when you have market-wide risk sentiment, which is positive impacting. But how you model that is tricky, I've got to admit. It's just something that I've observed. So maybe you could try something like that if you have a lead lag. But definitely some currencies tend to move with others because they do a lot of trade between them and so on. Euro and sterling as well, typically you see relationships. Even inflation as well. Some countries, the inflation will be more linked. Like again, the correlation between UK CPI and Eurozone CPI is quite a lot. But then if we look at some other currencies, like if we look at India CPI, that tends to move quite independently. It's
Yeah,
not really going to be, it's not really a precursor for others.
yeah,
And there it's like the big thing is it'll be like very local factors like
yeah,
top tomato, onion, and potato. If you don't have them in your model, you can't model Indian CPI, by the way.
yeah, yeah, I know.
Seriously, that's important. Yeah,
Yeah, thanks,
yeah,
thanks.
that's all right.
Okay, I think Paul can take the questions on HFT, I guess.
Yeah, so guys, let me see. There have been a few questions on HFT. Uh, I mean, yes. So, I mean, Saeed has already answered. Do you have to be a good programmer? You have to be an exceptional programmer, right? With in-depth understanding of architecture, hardware, of low-level stuff, right? So that kind of goes without saying. And there was another question here. I'm just going through the chat. Um, yeah, we do KDB as part of QGC. There is a module on KDB. In modern HFT, what's the biggest bottleneck today? The biggest bottleneck is your amount of capital, right? So to really join the game at a serious level, you have to invest into really expensive infrastructure, uh, hardware, right? Plus, you have to build your own framework, but also you have to collocate. You need to collocate potentially in multiple venues, and that all costs a lot of money, right? So it's not something that sort of a retail person can enter right at will. It normally requires sort of institutional levels of capital, right? Millions of investment before you can actually move into this area. Right, it's much easier to be employed by an HFT than starting an HFT, right? Because we
Yeah.
are really talking about very serious upfront investment when evaluating a new training. Okay, so I think Said has answered that. I don't see much else on HFT, but I mean, I remember there was a question which was kind of HFT specific. Maybe if you have that question, you can repeat that question. How is AI ML taking over the trading strategy? I mean, it helps with the development. I mean, I use it a lot in my work, right? So, for example, um, just like even just analyzing data, sometimes I just give it a time
Yeah.
series and say, like, look, what's happening with this time series? Are there kind of any obvious, just I can paste the graph, for example, and say,
Yeah.
is there something obvious going on, right? But also writing code, so kind of just write.
Yeah.
I mean, grabbing data, right? Please write just feed handler for this data source. That works very well.
Yeah. I think
Mathematical
what
proofs. Yes, sorry, say.
Yeah, one thing I would add though is that, and I use it a lot for writing code. Our team uses it a lot. I know Paul uses it, but um, when it generates code, try and understand what it's doing, because otherwise you won't be able to maintain it. So when it gives you
Yeah,
the code, this is a key point I would say to people that you have to learn how to code. I would say that's important. Otherwise, you'll have lots of code that you have no idea how it works. And then when you come to maintain it, it's like no one knows how to fix it. So this is really important. I don't know if you would agree. I'm sure Paul agrees, but
you accumulate technical debt, right? If you
yeah,
can generate, you gain speed at the expense of technical debt, right? So you kind of answer. You have something that seems to work, right? And then you have to make a decision. Okay, am I going to deploy this? Is it production? Is it non-production? Can I deploy it in research? How much? What's the cost of an error in this, right?
yeah,
So, and then you have to kind of understand it. You have to kind of re, you have to pay the technical debt, right? How would you recommend an engineering grad currently pursuing MBA to pivot into quant roles? I mean, yeah, develop your understanding of software development and mathematics. Oh, it's very good for mathematical proofs as well, right? So I mean, mathematics allows you to sort of think deeper about, what's going on with this regression, what's happening here, how can I look at these market regimes? Like if you have hardcore mathematics, it helps you kind of formalize a lot of things, right? And then it really helps with proofs, right? So, for example, it would take me a week normally to solve something like Hamilton-Jacobi-Bellman equation, right? Whereas I can do it in 10 minutes with one of the modern LLMs, but then I have to verify the proof, right? Then I have to sit down and actually go through the proof and stuff like that. Do you build models with multiple? By the way, if you want, like, if you are doing something mathematical heavy and you're not sure whether your proofs work and you don't have colleagues who understand the proofs, which is possible, then what you may end up doing is implement this stuff in Lean or something like that. And actually, LLMs can help moving the mathematical idea to Lean, and then you can automate the proof. But okay, so do you build? I mean, with the HFT stuff, I think there was. I don't see there was kind of an okay Markov switching. Yeah, I mean Markovs are pretty good market regime models, but there are others as well. I mean, there's a lot of stuff. You need to kind of define what market regimes work. I mean, okay, here's the thing, right? Okay, so you don't want to just take all this stuff on faith. Yeah, you don't want to just say, okay, so there's some dude sitting at UCL telling me to use Markov switching, and therefore I'm going to do it because that dude looks pretty on the photo. Yeah, don't do this, right? I mean, like, or he's a famous dude, like, I mean, he's been like on TV, and well, Said and I have been on TV, but that's not the reason you trust
Yeah.
us. Right? The reason people trust us so much is because we're just reliable and just generally good people. You see, but when you look at something, you know, like even something that I have written, you kind of need to say, okay, does it really make sense in my markets? Can I implement? Can I test it? Can I perhaps break it? Right? Where does it break? Does it apply to the situation? Can I actually implement? Does it give me reasonable outputs? How do I know the outputs are correct? What are my? How can I verify the outputs? Right? That's the kind of reasoning you really need to do. Right? So it's not like, oh, this dude told me use Markov switching, use Kalman filter, use regression. It's more like, okay, so it's just an algorithm, right? So I mean, these are the outputs of the algorithm. How do I know that the outputs are correct? How do I know the outputs are useful? Right? So you need to kind of come up with a workflow where, and that's, you know, that's both in HFT and non HFT, right? So, but like if you had, yeah, if you had an HFT specific question, can you just paste it now and I'll try and address it? Because I can't find. I think I've answered everything that I saw that was
I think there
HFT.
was an HFT question about QDC if you're experienced in low latency programming.
Oh yes, yes. So I have done low latency stuff at several places, including Deutsche. Deutsche has internally, I didn't mention this, has an
Yeah.
HFT group, right? But as part of the generally FX franchise, but more broadly, electronic fixed income, basically. And I've also worked for a company called QSpark, which is a pure equities HFT, and it's using C++ and FPGAs and things like that, right? So I mean, I've worked in HFT specifically for a number of years, um, and yeah, and there is content on that. Actually, the last module of QDC, which is this kind of electronic trading, has a lot of HFT content in it, where I talk about networking, where I talk about sort of how to optimize your code. I give you examples of the type of code that you would write. Doesn't necessarily make you sort of an HFT guru straight away, right? You kind of, at least it tells you what sort of things you need to know. You need to know about networking. You need to know about hardware and about software development, about the business. So these are kind of the pointers that I give you, right? But it's like something that you would probably need to spend, you know, months to years on to really sort of develop an intuition for how these things work. Um, so I hope. What did I do in 2023 to win Quant of the Year? Well, that's kind of embarrassing. I was pushing at the time. I was teaching and I was pushing reinforcement learning, and it's kind of reframing a lot of the finance in terms of reinforcement learning that people liked. And it's, I mean, that's actually some of my fairly widely cited papers are on reinforcement learning. In practice, like in practice, you don't really need to do a lot of the reinforcement learning. You have to do it differently in finance, right? Because you have the advantage, right? Unless you are like really doing something market impact sensitive, you can assess the multiple. You don't have to take actions to assess them, right? You can assess the chosen action, but like reinforcement learning is all about computing the v function, the v function, the q function, right? So it's actually much easier to do it in finance because you don't have to trade to kind of compute the state of a specific, the q value of a specific state. You can compute the q value of many states that you didn't take. Yeah, so you actually can do better than classical reinforcement learning in finance. So I hope that's kind of useful takeaway. Is statistical arbitrage? Yeah, I mean, statistical arbitrage is a very broad term, right? It's not just co-integration, right? Co-integration is just one specific small part of statistical arbitrage. So depending on how you do it, it is still profitable, but it tends to require, like a lot of statistical arbitrage does require HFT infrastructure, right? It does tend to, I mean, it depends what you call statistical arbitrage, right?
I think probably for crypto, probably venue still be something you could do, or not as much so.
Actually,
I don't know.
you right now, so we were running few stat in crypto. So cross currency exchange arbitrage can get you like 2-3% monthly. You just
Yeah,
need a very good network, and then you need a very good infra.
yeah,
So if you are running like one between two exchanges, but they should, if let's say Japan AWS a lot of same exchanges, like a lot of exchanges
yeah.
AWS Japan, and if you are doing between exchange which are in Japan AWS Japan, you can pull out 2-3%, but it's again you need a very good infra, like a very high quality infra and
But
network
Yeah.
and
you're not
everything.
collocating, right? You're not collocating. You are just locating close to the exchange
Yeah, yeah,
because
I think
in
you have
crypto,
to be. Well, I was going to say in crypto, if you work out what AWS region they are, you need to be in the same region, right? So you
yeah,
ping
yes.
them
yeah,
to work out. Yes,
yeah.
I think crypto is probably a bit slower than other venues. I would have thought still.
No, the thing is, it's still yet to be exploited the way the equity market has been exploited.
Yeah,
It's just
it's
the
true.
idea which a lot of people are still getting into. So it's still you have a bit of alpha left in there, but let's see how it goes in coming years. So because I have like one of my friends desk run the same app right now, and they're doing pretty good in this particular. But capacity is a bit of a problem in that.
So
Yeah,
that's a general problem with HFT.
I would say in general, capacity being a problem is probably good if you don't have much capital, because if there's a big capacity in something, it's more likely that a big player would have taken it out
Yeah,
already. Whilst if the capacity is small, then maybe admittedly for HFT you don't have the infrastructure, but something which is slightly lower frequency, potentially you can harvest the alpha from that, maybe which a big firm would not bother with.
yeah,
Potentially is that's something to think about too. So
There are some players in crypto that are offering collocation, right? Gemini offering collocation, a few others are offering collocation,
yeah,
right? But the question is, if you're doing cross-venue arbitrage, right, then you can collocate one leg, and then what do you do with the other leg, right? So I mean, like you
yeah,
need to somehow, there's this still the question of how do you get the information from A to B, right? Whereas like classical equity HFT uh, can be cross venue, and you typically use things like microwave communication and stuff like
yeah,
that, right? And you collocate all of the legs, right? And then you have very fast communication across between the venues. It doesn't have to be cross venue, the arbitrage. It could be looking at sort of co-integrated or correlated products, or you could be looking at certain anomalies throughout the day, right? So, I mean, a lot of these things go on the startup, but it depends. Like some people call the crypto stuff HFT. Some people don't call it HFT because ultimately your network lags are, it's you're not playing the nanosecond game, right? You're not really playing like the equities kind of how do I squeeze the last like micro nanosecond out of this, right? So this is and a lot of the like classical HFT tends to happen in equities. If you have a trading strategy in US equity indices that trades 20 times per month on average, is it good to have 10 seconds on average from getting the model signal to have it? Well, it depends on how. These are two separate things, right? The trading frequency is one thing, right? What you probably want to measure is how often does it change direction? How often does the signal actually change direction? That's something you want to measure. But
yeah.
how sensitive it is to execution delay is a separate metric, right? And you can backtest both.
Well, I was going to say it depends upon how long the alpha lasts. That's the problem.
Yeah,
Is it a very short-lived alpha, or is it like, for example,
exactly.
if your signal is over the next day, maybe 20 seconds doesn't make too much. But then if you have a 5-minute trade, typically I would say that a big delay is probably going to be a bit of an issue potentially.
Yeah,
Um,
realized and applied vol is we did something at Lehman to that extent. That brings
yeah,
up some memories.
yeah. So basically, what you end up doing is you're trading volatility. So ba one example of this is you basically have a straddle. Let's say you're selling a straddle and you delta hedge that. So roughly speaking, you're trading the gamma weighted difference between implied and realized. So if you're short gamma, you're saying implied is too high against realized. And typically it is because you have risk premium. Um, but ideally, you probably want to be able to do your own forecast for implied volatility as well. Although these days, I'd say FX vol markets are really efficient, so I'm not sure how much mileage you get from that. But you would ultimately want to forecast your own implied and compare that to the market. Stuff like volatility swaps are quite exotic, I would say, in FX. But typically, the way you trade it was with a straddle, and you delta hedge it. Then you need to decide like how often do I delta hedge? Do I where do I put my spot ladder for delta hedging and stuff like that? So it's probably a bit more involved, I would say, than spot. The thing is, it's difficult. At least for me, it's difficult enough understanding FX spot. So there's more complexity, I would say, uh, with volatility markets in general. But typically, you tend to make money being short vol. The issue, though, is that you can blow up sometimes. This is a problem with it. Um,
I'm mindful of the time. I think we've just hit 4 o'clock London, right? I mean, is that when we finish? I
yeah.
think it is, right?
Yeah. Paul, I had one question I wanted to ask.
Yes.
So it's like OBI is very well like known alpha in the HFT side, right? People like like use OB or like order imbalances. So
Yeah.
like the thing is, it decays as the time horizon of the OBI increases, right? Like if you have a OB of a long horizon, your decay it will decay. So how do you choose a prediction horizon for a order imbalance signal so that it can capture like genuine microstructure micro market microstructure pressure rather than the noise basically? Like
Yeah.
how do you get a better signal and how do
Yeah.
you
So,
set
so,
that horizon for the order imbalance?
so a plot that I often produce for short-term signals like this one
Yeah,
is I just plot the time horizon on the x-axis, and I plot some sort of metric which determines the quality of the forecast. On the y-axis could be r squared, or some sort of modified r squared, right? So I typically look at that. And for this kind of stuff, you normally have a peak, right? So where you have kind of the best, but then depending on how you monetize this alpha, you may go kind of a bit to the right of the peak, right? You can also use some of the multi-horizon forecast techniques, so you could actually forecast it at multiple points. This can be one of the inputs. It doesn't necessarily have to be your signal for this trading strategy. You could combine it with some other ideally uncorrelated things, right? But it is known that even if you do have a strong order book imbalance signal, uh, you need pretty good infrastructure to monetize it because it's short-lived, and depending on the type of the market that you're looking at, it can be easier or harder to monetize. So you really need to kind of factor that in, right? But if it is monetizable, then I would probably um, then a separate monetization horizon is like what's the horizon that gives you the best monetization, and it could be to the right of the peak of your R squared. Yeah, but it's a graph I always produce, right? If I have some
okay.
sort of like a forecast signal, I usually try to check over how quickly does it decay with time horizon.
And also,
Yeah.
just one more follow-up question on the same. So, how do you basically incorporate like multi-level or book information to like on the basic OBI framework?
Well, the order book imbalance naturally extends to multiple levels, right? You just
Yeah.
compute it across multiple levels. The point is you start increasing the noise,
Okay.
right? Because what happens is, so beyond the top few levels of the book, basically you get a lot of garbage then in the order book,
Yeah.
right? So I mean, it can be very deep, it can be hundreds of levels deep, and so on. But it's really what's happening at the top few levels that actually gives you significant information. You can do some anomaly detection a bit deeper, right? You can kind of go a little bit, you can do some different stuff. You can say, oh, is there something weird going on deeper in the order book? But typically, for this type of signal, you can naturally generalize it to say 2, 3 level, 4 level, order book imbalance. It doesn't just have to be top of book, right?
Yeah.
It's just you just naturally extend it, and then see which of those gives you the best forecasting power. So typically, what happens is it's maybe the top 2 or 3 levels that give you the best forecasting power. A lot of these kind of high frequency metrics, they generalize to multi-level stuff. But depending on the market, the information content normally decays fairly quickly as you leave the top of the book.
Hi, Paul. I have a quick question. So, for price prediction, do you prefer simple regression models, or should we go into machine learning models? Like the question is
Neither,
more towards, oh really?
neither. I tend to handcraft the signals, and I tend to use the signals that give me position directly, right? I mean, sometimes I do prediction as an intermediate step, right? And it's but your output is not really the prediction. Your output is the position that you want to take, right? Or if you are market making, the skew, right?
Mm-hmm.
So
Yeah.
Okay.
I guess it goes back to the stuff we said. I mean, you don't necessarily have to forecast the
you
price of
don't
the
have to.
asset you're trading. So, but you can ask multiple people, and different people will tell you different things. So some people are very wedded to
Sometimes I
forecast
do,
market.
sometimes I don't. Sometimes I
Yeah,
forecast,
yeah.
sometimes I don't, right? Once you have the forecast, then you need to translate it into. But as Said is saying, uh, especially for intraday stuff, I tend to just find some signal, map it to a position, backtest it.
Okay. Okay. Thank you. Thank you.
All right, being mindful of the time, I think we have to stop here, right, so that we don't hold people up for too long.
No, it was great discussion actually. So it's not a problem. We can discuss it. So yeah. Also, just one more thing I wanted to ask. So like generally HFT signals are more linear in nature and do not have a lot of heavy compute kind of a structure.
Yeah.
So do you think you can use like let's say I take heavy powered GPUs and start putting
Or
heavy
FPGAs.
compute signals?
Yeah. So, I mean, development costs tend to still dominate,
Yeah,
right? So, and infrastructure costs tend to dominate. Like you're not like running an AI shop in the
yeah,
sense that your costs are unlikely to come from, pure electricity stuff.
yeah,
But you can lower. You get better latencies with FPGAs, and you also get more energy efficiency with FPGAs as well. It's just the expertise is much less readily available. You would
yeah,
have to become an FPGA expert, and then it's also not transferable in the sense that, there are significant differences between different types of cards, between different vendors. So it's not like you have CUDA and that's it, like in
yeah,
GPUs, right? So that's one area where there are quite a lot of organizations hire FPGA experts, even people who claim that they're non latency sensitive, like XTX were a few years
yeah,
ago, hiring FPGAs experts,
yeah,
and so it's ideally, I mean, currently the most energy efficient technology is ASICs. But ASICs are not reprogrammable. So, you spend, I don't know, like 10K on this card and you mess it up, you have to buy a new one kind of thing, right? So I think FPG, but you can use a combination of FPGAs and ASICs. You can prototype an FPGAs, and once you're happy with the design, you can move to an ASIC, and that brings down your energy footprint.
got it.
Okay,
All
cool.
right.
All right.
Talk to you later, guys. Have a great
Thanks.
weekend.
Thank you
Thank
so much,
you.
thank you so much,
Thanks
Paul
all
and
for the
Said for the
questions.
great session.
Bye
Thank
bye.
you, everyone.
Thank you very
Thank you.
much.
Appreciate it.
Thank you everyone for joining.
Bye.